It just may be the hottest question of the summer. Will the Federal Reserve pivot towards lower interest rates? If changes do come, it'll be especially important for bond investors to consider the ripple effects. In late July, the Fed held rates steady for the fifth straight time, despite growing calls from the administration and others for cuts to help stimulate economic growth. Let's look at some reasons why the Fed paused its rate cut campaign this year, why we believe cuts could be coming soon, and how investors can prepare for that possibility. Why did the Fed pause? The Fed's two mandates, stable prices and maximum employment, are often at odds. While rate cuts can spur hiring and economic activity, they can also lead to prices moving higher. With the economy still strong and concerns that tariffs could make goods more costly, the Fed has been careful to not prime a new round of inflation. Why do we anticipate a pivot? We believe the Fed is now more concerned with the other mandate, full employment, especially after slower than expected job growth in July. Though timing is uncertain, the market currently expects 2 rate cuts this year, starting as early as this September. Market yields appear to be anticipating as much. The short end of the yield curve has inverted, something that typically happens only when rate cuts are expected. So, how can investors prepare? Start by reviewing your bond investments. If lower rates are on the way, shifting some short-term bonds to longer durations could help you lock in higher income before a rate cut pushes yields down. And keep in mind that cash accounts are particularly susceptible to declining rates. You might consider moving excess cash in your portfolio to bonds or other investments. Of course, rate cuts aren't a certainty until they happen, and interest rates are just one factor to consider in a well-diversified portfolio. Speak with your advisor about what changes, if any, might be suitable for your situation. And that's the Market Decode.